How buying a house works. Meet Milo. Milo's tired of renting his little banana treehouse, so he decides it's time to buy a home. Adulting level unlocked. But buying a house isn't like ordering DoorDash. You don't just tap and own it. You need money, you need credit, and you need something called a mortgage. Let's say the house costs $400,000. Milo doesn't have that lying around because he's not that kind of monkey yet. So he saves up for something called a down payment. That's where most monkeys are going to put down 10 to 20% of the home purchase price. So in that case, that's $40,000 to $80,000 upfront. Milo decides to go with 10%. So 10% of $400,000 is going to be $40,000. So that means he's paying upfront $40,000, which means $360,000 is remaining. That's going to be covered by a loan from the bank, and that itself is called a mortgage. Now here's where it gets real. The mortgage is usually 30 years long. Yeah, I know, 30 years. That's probably older than Milo. But yep, that's normal. It keeps the monthly payments lower. And at a 6.5% interest rate, Milo monthly payment is around $2,300. And that covers the loan, interest rate, taxes, and homeowner's insurance. And the house price isn't the full story, as you can tell. There's a whole squad of extra costs. This includes property taxes, homeowner's insurance, maintenance and repairs. Yes, you fix the toilet now if it's broke. Closing costs, usually 2 to 5% of the price. And HOA fees if you buy in a really nice jungle neighborhood with, banana ball pits and pools. But at the end, it could be worth it. So you might be wondering, why do you want to do all this? Well, because when Milo pays his mortgage, he's not just paying the bank. He's actually building something called equity. And this is just a fancy way of saying owning more of the home over time. So that means if the home value goes up, that's extra money in Milo's pocket. For example, he buys it for $400,000. You sell it 10 years later for $500,000. Boom, that's a $100,000 profit. And no, you don't have to stay for the full 30 years. Milo could sell the house at any time he wanted to. He just pays off whatever's left on that mortgage with the money from the sale. So if Milo owes $280,000 left of the loan after 5 years, and he decides to sell the house for $450,000, he pays off the $280,000 and keeps the rest. The 30-year loan is just the max term. It's not the trap. That's the max it's ever going to get to. And plus, there are some tax perks. Milo might be able to deduct mortgage interest and property taxes on his personal taxes. So when you get that tax bill every year from your income, there are some areas that you can deduct a lot of taxes off your earnings for the year, because that means less money to the IRS. So here are the 5 rules that Milo needs to do to ultimately get this house. 1, he needs to save up at least 10 to 20% for a down payment. Number 2, you need to keep housing costs under 30% of your income to live comfortably and not live off peanut butter jelly sandwiches or just nothing. 3, get pre-approved, which means that you just basically get a note from the bank saying, hey, you are a qualified buyer and you can go shop for houses. 4 is budget for repairs and surprise expenses, because you really never know what's going to happen. The roof might fall off, the yard might need some work, whatever it may be. And lastly, don't buy for the vibes. You really want to just live there for the long term. You don't want to live there for like 2 years and just dip. Now, ultimately, it's not just about picking paint colors or posting a "I just bought a house" selfie. It's a financial strategy. But if you're like Milo, prepared, patient, and playing the long-term game, then homeownership might just be your next power move. Hope this helps. Like and subscribe for more.